Good afternoon, and for some of you tuning in, good evening, depending on where you are or in the globe that is tuning in today. Today we are kicking off our sixth session of the 10-part Forbes Mazars Pillar 2 technical series that really covers today Article 4 of the model rules. Up to now, in the previous sessions, we did an overview of the transitional CBCR safe harbor rules and certain things you need to think about in the transition years. We did a whole two sessions on MNE group determinations, one being rather simpler ones and ones where you have a more complex fact pattern. We did a tax accounting overview and impact session as well. And in our last session, we started scratching the surface on diving into Article 3 and the computation of globe income and all the book to globe adjustments you need to think about. Today, the agenda today is we're going to talk about covered tax expense, what goes into the adjustments that go there, and what goes into the DTAA amount, and basically everything that rolls into Article 4. Without further ado, though, I'd like to introduce today's speakers. My name is Justin Metcalf. I'm a director with Forbes Mazars U.S. office in Charlotte, North Carolina, and I will let my colleagues here introduce themselves.
Hi, everyone. My name is Kira Miles. I'm a director out of our Charlotte office as well. Happy to speak with you today.
Hello, everybody. My name is Florian Mengele. I'm a tax partner based in Munich, Germany. Hello to everyone.
So before we dive into Article 4, let's kind of do a recap of where we are in the top of tax calculation. So for those that have tuned into the previous sessions, I apologize for the repetitiveness, but for purposes of giving everyone kind of an even keel understanding of where we're at, what you see in front of you here is a basic regurgitation of what the top of tax liability computation requires under Article 5. And as you can see, you have to get to this answer, you have to figure out your top of tax percentage multiplied by your excess profits by that jurisdiction. Today, we are going to cover that one little segment below in the top of tax percentage that talks about adjusted covered taxes, since we covered net globe income and loss, which falls under both sides of the equation. So to understand, adjusted covered taxes, as I mentioned earlier, there's four elements that the model rules really lay it out in four elements, right? You have to figure out what is your covered tax expense, and your covered tax expense, and we'll go into a little more detail on that here in a second, but it's basically taxes on profit, right? Current tax expense on financial accounting net income or loss straight from your books. Then there's certain additions and reductions to covered tax expense that we'll go into. And then there's this mechanism called the total deferred tax adjustment amount, the DTAA, which is really a mechanism for addressing timing differences with respect to deferred taxes. And then there's certain lingo in the OECD model rules that dives into items that are recorded in OCI and equity items that require corresponding adjustments. So the plan today is to cover all of these. So without further ado, adjusted covered taxes, right? As we mentioned before, it's Article 4. What we're really looking for is any taxes that are recorded in the financial accounts of a constituent entity with respect to income or profits, right? This is, kind of your in lieu of taxes fall into this, and that drives in for those that are U.S. tax experts in the 901, 903 concept. The definition for covered taxes is broader in scope of taxes, because the idea is to encompass certain taxes that in the OECD's eyes are really on profit or income. We'll go into, there's a variety of elections and required adjustments that we will dive into in future sessions in this series. So we won't spend a whole lot of time in the elections because there's a whole segment with respect to that. But the idea here is to give you kind of an introductory overview of what covered taxes are. So without further ado, let me kick this off to my colleague Kira Miles to take us into the first piece of understanding covered tax expense.
Yeah, thanks, Justin. So yeah, as Justin said, our first starting point is going to be just that covered tax expense, that first book. We're looking at what is your final current tax expense. So your financial accounting net income or loss tax expense, what's included kind of below the line. What we're really looking at here, as Justin kind of alluded to earlier, is our ultimate goal is to look to see what adjustments do we need to make to be consistent with the adjustments that are made in our globe income, right? So as we add amounts to FANL to get to globe income, what is the associated tax with that? We can increase adjusted cover taxes for those. Similar, when we remove it, we should be making reductions in those. And then, of course, we're looking to make sure that there's no duplication of any of the taxes that we're taking, so we're not skewing our overall ETR. So our starting point, the adjusted cover tax expense in your FANL, you're looking at taxes for the financial statements, taxes on actual and certain deemed distributions, taxes imposed in lieu of current income tax, and taxes on certain components such as retained earnings, corporate equity, and different items, just kind of based on what jurisdiction the constituent entity is paying taxes in. It also includes qualified imputation taxes. So an imputation tax system is an arrangement where shareholders who receive a dividend also can receive a tax credit for corporate taxes paid by the CE, or the constituent entity. So that will be included in your adjusted covered tax expense to the extent that that tax is not part of a foreign tax credit regime. When that dividend is received by the beneficial owner, that beneficial owner is going to pay a tax equal to or greater than the minimum rate. So right now that'd be 15%, or the beneficial owner is in the same jurisdiction as the constituent entity, and that dividend is going to be taxed as ordinary income. And then there's also a carve out for certain amounts paid to certain special entities, such as governmental organizations and such. And that'll be kind of contrasted against what we're excluding that we'll see in a future slide. So, but the covered taxes do not include any of your normal Pillar 2 taxes, right? So IIRs, DTPRs, QDMTTs, none of that's going to be in your starting point because, of course, it would skew the overall calculation that you're pulling together. Taxes on certain insurance items are also not included. And then disqualified refundable imputation taxes would not be included. So when you have an imputation tax that is refundable, generally that will not produce a single level of taxation in certain cases. So those taxes, once the dividend are paid, are refunded either to the CE or to the recipient. Therefore, no one's paying the tax, so you can't include that in your adjusted cover taxes. So it is important when you have those imputation tax systems to make sure you understand, do you have a qualified or disqualified adjustment that needs to be made there? And that's going to bring us to our first polling question. So has your company considered the allocation methodology for cross-border current taxes? Because that's kind of our next item that we're going into.
In the meantime, here we could just answer one question that was raised here. That is, are return to provision adjustments included in covered taxes? Basically, yes, they are. If they are related to covered taxes, if they're corrections to covered taxes. However, you will have to look at the provisions in 4.6 of the model rules. So they are, as you mentioned correctly, prior year adjustments. So if it leads to an increase of last year's taxes, this will be kept in the actual year. If it's a reduction, then basically you will have to recalculate last year. Under 461, however, if your correction is less than €1 million, then you can keep it in the actual year.
Florian, to your point right there, a good point on that, right? On the additional top-up tax liability, right? One of the sessions earlier, we spoke about what is the total top-up tax with respect to Pillar 2, and it's really your current year top-up tax plus your additional top-up tax liability. That that is directly playing into that second component, less your QDMTT. So great question though. That's one we've seen quite a bit popping up as well. So it looks like from the polling here, we have a lot of folks say this is not applicable. And then the second most is no. So let's talk about this mechanism. So, this is really getting to the June 2024 administrative guidance that really, added a whole laundry list of items to consider when you're figuring out your adjusted covered taxes. It was phrased in the context really of main entity and subsidiaries, but it extends to foreign branches, CFCs, hybrid entities, transparent entities, and withholding taxes on dividends are factored in. And what this June 2024 administrative guidance really laid out was a mechanism for when you have these regimes very similar to the U.S. where you have cross crediting. So in the U.S., we have a very complicated foreign tax credit system where you have general basket, passive basket, foreign branch, foreign tax credits, and you can have income let's just pick on the passive basket. You can have income, dividend or say interest income from Spain and say royalty income from say Germany, right? And all that income is being factored into factoring in what is the net tax expense in the U.S. paid on that income. So this cross crediting mechanism is obviously kind of a big no-no in the Pillar 2 context. So the OECD released these rules and kind of gave us a 4-step methodology on how to tackle allocating those taxes paid in the U.S. right to these different baskets. And what they say, so this is kind of a way of backing into what I think is really the Subpart F regime as well. It does note in the administrative guidance that blended CFC tax regimes like GILTI, which we'll talk about after this, are not considered in this methodology. And it's, which is interesting in and of itself because Subpart F, GILTI has different mechanisms for calculating GILTI than Subpart F. So I almost see this as a mechanism of how you think of Subpart F in the context of current tax expense. So with this 4-step methodology, and we can be here for almost a whole hour in and of itself. So I'm going to kind of give a quick overview on what this 4-step methodology does. But what it asks first is define what the foreign source income taxed by the main entity is first, right? And what they're referring to is income of domestic entities to the extent that the main entity and a parent entity jurisdiction considers income to be from foreign sources for purposes of determining to what extent an FTC is allowed. And you're basically in your 904 limit calc, right? It could be a main entity with a PE group, but it could also extend to a CFC or a hybrid entity regime. So that the very first step is defining what that foreign source income is, and what it does not mention how to classify, but it does mention to define what that income is. The second component, right, is figuring out what your allocable covered taxes are, right? And basically what they're saying in the guidance is these are residual taxes paid by the main entity after considering the FTC, right? This is if you have a residual general basket foreign tax after the foreign tax credit limitation, something like that would come into play. Same with the passive for those that are U.S. aficionados. And it gives us a formula. And what that formula says is you take the total current tax expense accrued, right, less the domestic tax liability, less the blended CFC taxes to back into what that is. So blended CFC taxes, consider GILTI when you're doing this. So that's the second step. The third step, right, which is a little more, there's a little more complexity here, is once you figured out what your taxes are and your foreign source income is, now you have this allocation key, very similar to the GILTI one, which we'll talk about here in a second. And what it says is you take your inclusion, right, and multiply it by the applicable tax rate less the creditable tax. They give a more, they in the June 2024 guidance, they lay it out in different facets when you're thinking about it from a PE perspective versus other entities like CFCs. But this is the general, like the general gist of what they're trying to get at. And in a future session, we'll probably dive into nuances to this mechanism, but the intention here is to give a full scale overview of what these cross-border current taxes allocation is. This is basically allocating taxes from one constituent entity to another. It's not a book to globe adjustment. It's just where you put taxes that are uncertain to be put in your Pillar 2 full scope calculation. So once you've figured that part out, the second piece is then to determine the allocation to each entity in your M&E group, and it's based on the allocation key divided by the sum of all allocation keys. Very similar to the February 2023 guidance that was released. Just a little bit of nuance because what they're factoring in now, this final step really is. It's taking the total amount of the allocable covered taxes that we defined in step 2, and it's apportioning it basically between the PEs and the M&E groups in accordance with like a cross-credit allocation key that was defined in Article 3. So it seems relatively straightforward, right? But there are some nuances here to think about, specifically when you have different baskets in these jurisdictions that the OECD does have to give a little more guidance on, in my opinion. So without further ado, let's go into the next piece, right? And let's talk about the blended CFC allocation key. So the February 2023 administrative guidance provided a blended CFC tax, gave us a mechanism on how do we address a blended CFC tax regime's taxes. So really, this is targeted to the U.S. GILTI regime, and it wasn't even hidden. It was actually directly given in an example, which we'll go through a quick example after this. But what it basically says is it's designed to, this whole thing is, so GILT, for those that are unaware, GILTI allows, our U.S. GILTI regime and blended CFC tax regimes allow you to take income from, say, Spain and loss from, say, a country like Germany, and net the two to figure out what one GILTI inclusion number is, tested income and tested loss, right? As we know in the U.S., from a Pillar 2 standpoint, this is a big no-no, because Pillar 2 wants you to do this on a jurisdiction by jurisdiction basis, and cross-netting of losses makes our U.S. GILTI regime a non-qualified IIR. So for that reason and that reason alone, we have this temporary methodology that was released in February of 2023. And I should note it is temporary, and maybe this might be something that gets extended because it's no secret we had a pretty big U.S. election here, and the temperature in the U.S. market seems to suggest that we might have some problems with Pillar 2. So not to steer off track, what this allocation methodology says is basically says take your allocable blended CFC taxes and apportion it based off those that are below the incremental amount of 15%. And to put this into a more, for the interest of time, to put this into a more mechanical formula, right? You take your attributable income by constituent entity, and it's important when I stress entity to mention that constituent entity in the model rules talks about tested units of CFCs and CFCs. What it does not talk about, and this is interesting enough, it does not acknowledge the interplay of what a transparent interest is for those that tune into Reg 1.951A-2C7. So think about this. Think about that when you're modeling this out. But you take your attributable income by entity and multiply it by the applicable rate less the globe jurisdictional ETR. For purposes of the GILTI regime in the model in the February 2023 guidance, they mentioned that this is 13th and an 8th because the Section 78 gross up with the scale back of the 80%. gets you it's back into this 13 and an eighth, but you wonder, what's the interplay here, because guilty, as we know in the U.S., is 10 and a half, roughly. The globe jurisdictional ETR is basically your ETR computed under the globe rules. So, so when you're thinking about this, think about this in this context, and QDMTTs, right, are factored in and only allowed if an FTC is granted, which, as we know now, from the recent note from last year's notice, right, that the IRS Treasury intends to release regulations that will say that QDMTTs, to the extent that they do not factor in other countries' income, will be creditable. So, stay tuned to see when those regs get published. But in the interest of time, let's go through a quick example. So we have an M&E group here, right? UPE, ultimate parent entity, U.S. parent. We have a blended CFC tax regime, right? The foreign ETR, says it must be at least 13th and an eighth to prevent a CFC tax, right? We have CFCs in 3 jurisdictions with the following attributable income and ETRs. A has it, which is in, let's just say, is in France, B in Spain, and C in Germany. $100, dollars and 10% ETR. Assume, B has 50 and a 20% ETR, and C, Germany has a $25 and 5% ETR. Assume we have a $20 CFC tax that needs to be allocated, a $20 CFC guilty tax that needs to be allocated for Pillar 2 purposes. So if we apply this, and this is a good example laid out in the February 2023 guidance, you'll see that there is no allocation to B, which is Spain, because it's got a 20% rate, hypothetical Spain. It's not actually Spain, but we're throwing out countries here, right? There is no allocation because the 20% is greater than the 13th and an eighth, right? So there won't be any allocation. That frees up the ability to move this tax between Germany and France, which, as you see here, translates to 5.1 of blended CFC taxes being allocated. So understanding this here from a full tax perspective is important. Thus, going on to the next piece here, right? Now we have this blended CFC tax, right, where that now needs to be allocated. As you can see here, there's no allocation. There's no allocation to B, right, which is Spain, and the remainder is the full 20 is used to offset. It is used in the lower tax jurisdiction. So in a lot of ways, this allocation key is helpful, as long as you've done the analysis with the tested unit piece. So in the interest of time, I know everyone's looking for CPE here. I will keep this going, and if you have any questions as a follow-up, we can dive into this some more. But this is intended to be kind of a high-level overview. So without further ado, let me kick it back and let's talk about the Article 4 adjustments for additions and reductions to cover tax expense.
Yep. Thanks, Justin. So yeah, we're going to go over some of the more common ones we see. As a reminder, we're looking to have consistency between the globe income adjustments, right? And globe income goes up, what's the tax associated with that? That should create an increase as well. Common additions that we see are taxes that are included above the line, so those that are included in pre-tax book income. And then you can also get some for your globe loss deferred tax asset to the extent you make a globe loss election that we'll discuss later in the presentation. Oh, looks like my slide advancer might be stuck. I don't know if one of the other presenters is able to advance the slide for me.
Yeah, I think Kira might be having technical difficulties. So, let's talk about additional, your additions to cover taxes here. So, sorry, one second here. So, your addition to cover taxes, it's, designed basically, include all aspects to your covered tax expense, right? You take your covered tax that's accrued as an ordinary expense before profit, and you layer in your globe loss deferred tax asset that is made available by the Article 4.5.3 globe loss election. We'll talk about this a little more at a high level because we'll dive into more detail in a future session. But for purposes of this, consider that these additions to covered taxes are factored in there. There is a component here that looks to uncertain tax positions, right? So you would have an addition to your covered tax expense, for covered taxes paid in a fiscal year that relates to a UTP, where the amount that has been treated for a previous fiscal year was treated as a reduction to covered taxes under Article 4.13D. This doesn't include penalties and interest with respect to the UTP, and unless and until it's paid, the current tax expense related to a UTP must not be included. Any amount of credit, so that's one component. Another one, and if you tuned in to the last session, we talked about QRTCs, right? So QRTCs, qualified refundable tax credits, were talked about in the Article 3 exercise, because when you have a QRTC, there's an adjustment to globe income. One common theme when you're thinking about book to globe adjustments for Article 4 covered taxes is that they're usually what you do on one at the numerator, which is your adjusted covered taxes, there must be a corresponding adjustment to match apples to apples on the denominator. So if there's an Article 3 adjustment, there's likely an Article 4 adjustment you have to think about. So QRTCs, right, must be adjusted when you're factoring this in. If they're, so keep that in mind when you're going through. So QRTCs and MTTCs we talked about in the last session. So for those that did tune in, please refer to that. Marketable transferable tax credits. So those are your additions. You have reductions now, right? And what these are designed to do is to ensure that the ETR calculation for relevant constituent entities reflects taxes with respect to globe income or loss that must be paid within 3 years, right? And if it's not, then there's usually a problem, right? So what this is it's really equal to the amount of current tax expense with respect to income excluded from the globe income or loss. So these are items that are recorded in the books that there's an exclusion for globe, so there must not be a back out. You have to back that out, right? I mentioned QRTC. So if you have a non-qualified refundable tax credit, that is seen as a reduction that needs to be backed out. So in this, there's a theme here with QRTCs that I'll focus in on is usually it's a better answer for your globe calculation when you get to factor in a QRTC and the corresponding income, because there's an effect when you run the modeling for it that you get additional ETR. So think about this when you're diving into the reduction to cover taxes there. So in the interest of time, because I know we have to get to some polling, right? Any amount of covered taxes refunded or credited, are to a constituent entity are not treated as an adjustment to current tax expense. There is no reduction for QRTCs. So QRTCs are very different from these kinds of refunded or credited taxes. UTPs, right? Again, back to that. And then there's this one catch-all, right? And I want to focus in on this. So any amount of current tax expense that's not expected to be paid within 3 years, the last day of the fiscal year in question, is a reduction that must be factored in. So I mentioned earlier, one of the goals here to additions and subtractions are that you have to, that the globe rules are really aiming for current taxes that are to be paid within 3 years. We'll talk about this in the DTAA context later when you have deferreds later in the 5. So there is a little exception here that if you have more than euro 1 million of amount that's accrued by a constituent entity as a current tax expense and included in adjusted cover taxes for a fiscal year that is not paid within 3 years of the last day, the ETR and the top-up tax for the fiscal year in which that unpaid amount was claimed as a covered tax must be recalculated, because it goes back to our additional top-up tax liability comment that Florian jumped into earlier. So think about that when you're thinking about these additions and subtractions, and how they interplay. So without further ado, we will go directly into our polling question. So has your company considered the impact of the blended CFC tax regime allocation methodology to your M&E group? So this goes to the GILTI allocation key that was discussed in the February 2023 administrative guidance. That is a temporary methodology. You know, it's set. And one thing I didn't mention earlier that, you know, in the interest of time, while everyone's answering the polling question here, that methodology is there only until June 30th, 2026, I believe, or 2027. So it is temporary. And we may have a situation here where, you know, that could get extended. We don't know, right? The OECD does have to think about this, and other countries as well have to think about this, specifically with the US and the current political landscape. So give you all some time here, and then we'll go right into the next. So it seems like minority has factored in the as a minority of everyone has really considered this. And it's important to note that this is really to the full scope calculation. And you know, my understanding is a lot of companies out in the market today are really thinking about the transitional CBCR safe harbor. So this is something that factors in when you're doing the full scope calculation. So there will be, you know, items that you have to think about that are broader down the line. So this is all part of that Pillar 2 journey. So continuing on here, right, we are going to now talk about the total deferred tax adjustment amount, the DTAA. And I will kick this over to Florian.
Yeah, thank you for that. So that is, of course, the nicest part of the regulations. So just to give you a quick heads up, there is, of course, the basic design of that. So it shows that you have, you start with your deferred taxes as you have it in your P&L. The OECD thought not about having special Pillar 2 DTAs or DTLs. So that is your starting point. Then you do a recapture to the minimum rate, which is 15%. Please ignore that 70% that's slipped in from some safe harbor papers. If you have a tax rate below 15%, for example, 10%, then you do basically do not do any revaluation of that deferred tax asset or liability to tax losses carry forward. We will come later. Let's have a look a little bit on that June 2024 paper, because that is really complicated. There can be a cross allocation also of deferred tax liabilities or asset that is clearly mentioned and set out in the commentary. So some folks of you might ask the question, when do I do that? So what can be the instances when I really do allocate a deferred tax liability, for example? And there are some examples mentioned in the paper. One is if you have CFC tax, but it does not, do not take it into your tax base in the year when the income is generated, but the year after. For example, will include 100 of income in year one. That is your CFC income, and you will tax that in your main entity jurisdiction in year two with, for example, 20%. Then you will have in the first year a deferred tax liability for the future tax that you will pay of 20, and perhaps you will have some tax credit that you can offset. There you can have, for example, a €5 or dollar DTA for this tax credit. And that's basically the thing that we are talking about. A second example for PEs is if you are accounting for your your PE at your main entity level, and you may have some deviations for assets that have a different book value than you have on the GAAP also. So that's basically the two instances they mentioned that you have to do the allocation. They set out a 5-step methodology. That's, sorry, I'm a German guy. It's a complicated word for me. But you will not have every 5 of these steps in every case, because some case might be easier, so you can skip the one or the other step. So looking at the first step, which isn't pretty much a step. You do not do anything. You do not allocate something. You just look at your DTA and DTL, and you say, what is on the table? What do I have on my parent entity books that could belong to this CFC? And then there are three different categories that you have. First one, it could relate to some item which has a connection to globally excluded income under Model Rules 3. So that is the first category. The second category is you might have some items that some deferred taxes related to passive income of your CFC, and you might have some related to non-passive, let's say active income of your CFC. So the first step, you know what's on the table. The second step is a little bit of speciality. In that example that I mentioned earlier, we had a 20 units deferred tax liability and a 5-unit tax credit. You can post it that way that you have 5 DTA for the credit and 20 DTA for the liability, or you could net that up, that you only post 15, 20 minus 5 as a deferred tax liability and show no DTA for the tax credit. Both could be possible to do. So to treat everybody equally, the OECD says if you have a net posting of that, so you show only 15, then you have to deconsolidate that. So you still have that 5 in credit and the 20 in liability. So just mentioning shortly, what is a foreign tax credit that is included here? It's of course that one that you will pay for your CFC income. Paid does not mean in that financial year, can also be paid later. And then we have, if you have that basket system that you can cross allocate something, then you have to include also these tax credits. They don't give us proper guidance. They say we have to use a reasonable approach. Good that they mentioned that. Otherwise, we would have chosen some really crazy stuff. So that is the only guidance that we have here. So then we do the actual work. We do the allocation and a step 3. And then is that that the first thing is we exclude items that are related to globally excluded income. So that is not taken into account neither at the level of the parent entity nor at the level of the CFC. So they are basically excluded. Step 4 is we do the first real allocation, and that is related to active income. So if we have active income and in the CFC, and we have some deferred taxes related to that active income, we push that down. And first strange thing is that you do not do a recast, so you do not reduce it. If you have a 30% tax rate, so you post a 30 deferred tax liability, it's not that you do the recast in the first step, that you have 15 and push that down. No, you push the whole amount of 30 down, and then you do the recast on the level of the CFC. That leads you, just to give you some hint for that, that will lead that you have in a CFC deferred taxes with different tax rates, because those who are allocated have in their stomach, they have the tax rate of the parent entity and not of the jurisdiction where the CFC is located. So you have to be careful there. So after the push down, And after we have recasted our DTL, we do an offset with our foreign tax credits. And there is one bad news to this. Um, the credit is not recasted. So if you have 20 deferred tax liability calculated with a tax rate of 30%, that will be recasted to 10. And if you have a foreign tax credit of 5, that will go 1-to-1 in your offset. So it's 10 minus 5. You will have 5 only on deferred taxes that you can push down. So that's for the fourth step. And then we have step 5. So we have some passive income in our CFC, and in most cases, for example, European countries that follow the BEPS approach, we only have CFC taxes for passive income that we have to allocate to the CFC. And there is this strange little bit of limitation. So you only are allowed to push that down to the entity as to an extent that your top-up tax for passive income is reduced to 0. You cannot use some excess tax that you push down to offset a top-up tax that is due on active income of the CFC. So that is you have to keep that in mind. So if you have, for example, 20 euros you can push down to your CFC, and there is a restriction that you can only use 15. So the 5 will keep at the parent entity level, and you can push that down. There are some misunderstandings that can occur from that OECD paper because they did not do it very diligently. So the formula that we have seen on the step 4 is only mentioned there on the step 4, the first thing. But you have to apply the same formula to that step 5 allocation also. That's the same thing. And then something is misleading. We have learned that we push down taxes before we do the recapture to 15%. So that could lead to the opinion that if you have 30 taxes you can push down with a 30% tax rate calculated, that you push those down. And if you only have an amount of 20 that you can offset, so you reduce that to 20, and then you do a recast, so you will end up with 10. That's not how they really want to see that. In the June paper, there is an example where they say this maximum threshold that relates to the recasted amount of the deferred taxes. So you do not lose anything here. Don't get confused from the crazy wording. Of course, that maximum amount is very complicated and has some problems with who is eating first that amount of taxes. That's too complicated to be discussed here, but you have any questions, we are happy to answer those afterwards. So that one to the so far to the allocation, very complicated, but a new thing from the June paper. So we thought it's worth mentioning. Then what do we have in our deferred taxes that we have to correct? There are some adjustments that we have to make. Of course, we mentioned that if something is related to globally excluded income, take it out. If you have so-called disallowed accruals or unclaimed accruals, you have to take it out. The disallowed accrual is a deferred tax related to uncertain tax position, or if you have a deferred taxes that you show on future dividends, that is disallowed. You cannot show them on the GLOBE. Unclaimed accruals is something that Justin, you will then mention. You might all know that deferred taxes in some cases, liabilities are to be recaptured after a 5 years period if they do not reverse. you have the election right to say, I do not claim that in the first place, so you do not, I will not have to make a prior year correction. These are the unclaimed accruals that you have to take out. Then an important issue, impact of a valuation adjustment regarding a DTA. So if you have a tax loss carry forward and you want to show a deferred tax asset, but the auditors say you may not because it's not plausible that you make future profits or something, then you make a valuation adjustment under your local GAAP. However, you're allowed to keep the full amount on the Globi because it's very important for future periods. Otherwise, you would pay top-up tax when a tax loss carry forward is utilized. So,
hey Florian, for purposes just because we're running a little bit on time, a little delayed on time, I think it might make sense to do the third polling question just for CPE purposes here. So, yeah. Would you like to have a consult? Yeah. Then we can continue from there. Apologies.
Okay. So I have to reject because I have to check my notes here. Okay. So for the basic corrections, that was for the exclusions. So I think the most important ones that are then you have to do also some adjustments that I would go to the next slide. Changes in tax rate are not so often will not so occur. So disallowed accrual, if you have excluded a disallowed accrual and you later pay it, then you can include that payment in your adjusted covered taxes. And the same applies to unclaimed accrual. If you pay those, they always talk about pay. That's a little bit strange. It means if you reverse such a deferred tax, of course, you do not have that in your Globi vote, so you can make a correction to net that out to 0. Okay. So the last thing that we have to do as a correction is we increase the amount of deferred tax liability that is paid during the fiscal year. So if you will talk about that later, Justin, if we have a recapture because it didn't reverse within 5 years, and then of course you can net that out in your Globi tax calculation and increase your covered taxes. Your covered taxes will be lowered by the reversal of the deferred tax liability. You do not have this deferred tax liability in your Pillar 2 world, so of course you can make a correction to net it out to 0. And the same is if you have a loss in the fiscal year and you show a deferred tax asset, and then the auditors take that out because the criteria are not met. You put it in your Globi world, and of course, as a corollary, you have to reduce your adjusted covered taxes the same as you would have done if you would have shown your DTA in the first place in your financial statements. That leads to the same outcome. Okay. Do we have the answers to the polling questions so that we do not?
I think in the interest of time, we're gonna get to, just because we're running a little behind. We have 8 minutes till the end of this, so
yeah, we'll I think we can that very shortly. It's only the election for the Globi loss, though. So basically, you can just ignore everything what I said. No deferred taxes and have a deferred tax asset on your Globi loss. It's a one-off election. You do that with the first year where you file a Globi information return for the full scope calculation, not for safe harbor. Okay. I think I will hand it over to you, Justin.
Okay. Yeah. So, up to now we've been talking about, basically, cover taxes, additions and reductions to that, and then this DTA component, right? And in this DTA component, right, there's this piece under Article 4.4.4 that says to the extent the DTL is taken into account in covered taxes and it's not paid within 5 subsequent fiscal years, right, the amount must be recaptured, right? And as Florian noted, this could reduce your adjusted covered taxes, right? It hits you in the 5th preceding fiscal year and generally results in a recomputation of your ETR and top-up tax liability. This total amount is equal to the amount of deferred tax liability included in the total DTAA in that 5th fiscal year that has not been reversed by the end of the last day of that current year. So there is this thing called the recapture exception accrual, and it basically serves as an exception to this this Article 4.4.4 rule. And if an amount is subject to the DTL recapture rule is deemed to be a recapture exception accrual, no DTL recapture is required, and you don't have to reduce your covered taxes. So let's talk quickly, all right, about what falls into that category of recapture exception accrual, and then we're going to go into a little more of what the June 2024 guidance talked about with respect to categorizing your deferreds. So basically, this recapture exception accrual is any tax expense accrued attributable to changes in DTLs with respect to all these different items here. And you'll see, there's R&D expense, so they're trying to protect R&D expenses here. Cost recovery allowances on tangible assets, insurance reserves, insurance policy, deferred acquisition costs. If you have one of these items, right, this is not subject to recapture in the deferred tax liability context. So this could be claimed as an exception. So, but June 2024 administrative guidance gave us a little more guidance on how to track these from a data perspective, right? And what they talked about with this special DTL recapture rule is they lay out 3 categories. There's item by item method DTLs, right, that are subject to recapture. There's what they call general ledger account method DTLs and aggregate DTL category methods. So the first one is pretty easy, right? You can look to your books and see, hey, is there individual tracking DTLs related to a single asset or liability class, right? Where it gets a little more complicated, and in the interest of time, we won't have time to go into every nuance. Where it gets a little more complicated is when you have this aggregate DTL category, where you have DTLs grouped that may be related to 2 or more general ledger accounts, but fall under the same balance sheet or sub-balance sheet, and the general ledger accounts where there's grouping of DTLs to all assets and liabilities, like a catch-all, right? The June 2024 guidance gives a specific methodology on how to track these with respect to this DTL recapture rule that, in the interest of time, we won't cover. But for those that are tuning in, you have the slides here, on how to group these categories here when you're running this Article 4.4.4 exception. In the interest of time, we'll speed this up. There is a couple of exceptions provided, right? We talked about, so there is a short-term DTL tracking exception that basically says that there is no tracking required for your short-term DTLs if the constituent entity can objectively demonstrate that all DTLs in the aggregate DTL category or general ledger account category are actually short-term. This goes into the play of the 5-year rule, right? If you could show this is a short-term one, you don't need to track it. And this is important because when you're doing your DTAA, there is this new concept of tracking deferred tax liabilities in the context of GLOBE. Very similar to how in the U.S. rules we have different tax attribute tracking. So this is something to keep in mind. Then there is this unclaimed accrual election, which we'll talk about this in a later session, but it basically permits a constituent entity to exclude DTL accruals in a fiscal year if it's not expected to entirely reverse by the end of the 5th subsequent fiscal year. So it applies to all DTL tracking categories, the item by item, the group ledger account, and the aggregate general ledger aggregate DTL category. For the interest of time, we won't go into this here, but basically, you're just, it goes by a FIFO methodology of when you're tracking reversals. So the default rule so it permits FIFO, but the default rule is DTL reversals related to these accruals are generally on a LIFO method, but there are a couple of FIFO methodologies you can use when you're factoring this into the DTL recapture rule. In the interest of time, we'll keep going, right? Let's go to the fourth polling question here. So has your company considered the impact of making the globe loss election the first GIR to be filed? So for those that tuned in, right, if you make a globe loss election, and we'll talk about this more in depth in a later session, it basically allows you in that particular jurisdiction to forego doing the whole entire deferred tax adjustment amount exercise that we had discussed after the additions and reductions. It basically says you can, instead of doing this DTAA methodology, you can elect into the globe loss election, right, which would basically allow you to to quantify a globe loss at the minimum rate as a DTA, right, going forward, so that you could basically have adjusted covered taxes in a jurisdiction where you had a globe loss in subsequent years. So it does involve its own methodology of tracking, and the OECD model rules, and which has been enacted in a variety of different jurisdictions, requires that that election be made on the first globe information return filed for that jurisdiction. So for many, that will be June 30th, by June 30th, 2026, when the 2024 fiscal year is to be filed. So that said, I will kick it to Florian to talk about the globe loss election, which I kind of did a little bit of a quick
you mentioned
run
that, and I was wrong on the slide that I had to. That only thing that we wanted to mention earlier is that you have a DTA that is evaluated with 10% tax rate, and you can prove that it's related to a global loss. Then you can show more than that, 50% in taxes. I think we talked enough about the global loss election now. We will visit that again when we have a session about the election rights. One last thing that we wanted to mention at the end is that OCI thing that could be interesting. So it can be that your GAAP says some of your DTLs are posted in OCI, so you won't find them in your adjusted covered taxes. But if that is something that is subject to tax in your country, you can take these deferred taxes or other taxes into account in your computation. So that's a pretty nice thing. So I think that was the last correction that we wanted to mention. So we are 1 minute late. Sorry for that, everybody. Justin, I would hand over to you.
Yeah, so we just want to say thank you. We know your time is precious, and especially at a time of year in December where we're getting prepared for the holidays, and everyone, time is of the essence for a lot of people. So we just want to say we genuinely do appreciate you taking time out of your day to tune into our Pillar 2 webinar series, and really love the participation. So please stay tuned. The next few sessions we'll be talking about the globe information return, and as well as I mentioned earlier, the multiple different globe elections or globey elections. I use that interchangeably, but that there will be a session where we go through all the various different elections included in the model rules and the administrative guidances that follow, that will generally add a little more color to considerations that need to be made going forward. So without further ado, just want to say thank you for your time, and we look forward to seeing you all in a couple weeks. Thank you.
Thank you.
Thanks, everyone.